So welcome to Risk Explained, a podcast that is dedicated in helping business owners understand risk. Today with us we have Viktoria Soltesz, who is a payment expert with significant experience across the payment industry within the European Union, but not only. And we are going to discuss about risk in payments. Viktoria is also the CEO of PSP Angels, a company that is helping payment companies improve their operations in terms of payments. So welcome, Viktoria.
Thank you so much.
It's a pleasure to have you with us today. And I know that you have significant experience, and we look at financial services from different angles. You approach payments from the operational aspect. I approach payments from a compliance and anti-money laundering aspect. But we have a lot of things in common. And one of the things that we have already discussed and we agreed on is trust in payments. So what, in your opinion, what creates trust today? What destroys trust in payments?
I think we need to go back to the beginning to really understand that what is really money? What are we really talking about when we are talking about banking and payments? And why is it so much trust-based? So if you think about the only reason that we are using money is because we trust that whatever we do with that is going to be accepted and the other person who we are giving it to is going to accept as well. So the whole system is maintaining itself based on trust. If you lose that trust, there is no value on the coin or the digit on the screen. So every single step that banks are doing is to maintain that trust. If you ask a person on the street, like, what's the main purpose of the banks? Of course, they are giving you mortgage and they are giving you loan and they can hold your deposit. But the deeper understanding of what is the bank's main purpose is not really talked about, which is maintaining this trust. The bank's responsibility is to keep a society healthy, is to make sure that everybody is paying their taxes and no one can commit crime. So in a way, they are quasi-governmental because the government is making any kind of decisions, the monetary and fiscal policies and different decisions, increase and decrease the interest rates and whatnot. But the banks are the ones who are executing it. So the banks are monitoring all the money movements. They need to make sure that everything is according to the rules and the regulations and the laws. So you cannot cheat your taxes. You cannot scam people. You cannot sell something which is illegal. So if you see this in a larger scheme of things, banks have a lot of responsibility and they have a lot on their plate. So when we are talking about trust, it is one of the cornerstones that banks need to maintain. Banks need to make you believe that you will be able to use that money. You are safe when you're putting your money in the system. You will be able to use that money even abroad or when you're buying a house, and the money doesn't disappear after 20, 30 years. So the trust is an absolutely vital element, which is making the financial system go around. That's basically the whole purpose of keeping the trust.
And we have had some recent bank runs which were caused just because people lost the trust, even in reputable institutions. We are talking about a few years ago, we had Credit Suisse. What happened? They had a lot of problems, regulatory issues. They had a lot of AML penalties. And at the point where they found they themselves announced some weaknesses in their internal controls, people lost their trust. And what do you do when you lose your trust to a bank? You go and take your money, take them elsewhere. And even today, personally, I choose my bank, where to put my money. And even if I maintain accounts in different banks, I feel that with one of those banks, I'm going to do this, but I'm not going to put a lot of money there. So this is what happens because I don't trust that bank. If you ask me why, I'm going to tell you, I'm not sure, but I don't trust that bank.
See, this is the problem, that we are still making decisions about our money on a gut feeling. We are not talking about it enough. Why are you trusting this bank and not that? And these are your personal funds. Imagine when you're responsible for hundreds of millions of a company's funds. People's lives depend on you if the company is doing good or not. And then you're still making decisions of, do I know them? Do I trust them? Do I trust that country that the bank is incorporated? And it's such a sensitive subject that I feel like that we really need to talk more about. It's not just I trust this bank or not. There are obvious, very, very objective ways to evaluate how solid is that bank. What is the regulator who is holding over your funds, who is monitoring what are they doing with your money?
Did they pay any penalties during the recent years for
Exactly.
failures, for fraud, or AML penalties?
My point.
So these type of penalties, they make people lose their trust. That's why we come to AML compliance and how important it is, because actually it's a way for banks to protect their reputation and make people trust them. So let's say now I am a company and I'm gonna choose a bank or a payment provider. What what I may realize too late about payments?
How much time we have, right? This is a subject I can talk about for years and years, because that's what I do every day. I see people who are asking me this question every single day, which to choose, what to not. It's such a subjective topic, because every company is different. You have different clients, you're selling different products or services, you're on different markets, you're using different currencies, you've got different risk tolerance. So you cannot say that this is the bank to trust or this is the payment provider to trust. You have to filter out what is the best for you. But as we said at the beginning, no one really makes informed decisions. Everybody is trying to figure it out based on a Google search, or my friend trusts that, or
Reviews.
actually your reviews, yes. And you're trusting your money based on something that it's a gut feeling. So what I'm advocating for is we do need to have a bit more education on the subject. You need to make informed decisions. Is this bank good for me? Is this bank not? Is it the right approach for that? So when you're asking that, what are the main mistakes? I can say, first of all, you're making decisions on gut feeling. You're using your accountant to make that decision for you.
And is it good or bad? Is it a good decision to use your accountant, or a bad decision?
Listen, I'm an accountant. I know what we have learned. I learned everything about debit, credit, budgeting, even a bit of treasury, but I was never taught about what is open banking. What are QR codes? What is the difference between SEPA, SWIFT, and ACH system? What is crypto? What are the stable coins? Yeah. So if someone is coming to me and asking me as an accountant to make a decision over that, of course I don't know. Of course, I'm going to make a decision on a gut feeling. Of course.
And what do you believe that works?
Education.
Yeah.
And that's what I'm fighting for, that we have to have a standardized education. First of all, we need to recognize that this role of making decisions over payments and banking and cash flow and payment providers in a company is a standalone function. You cannot just put it on finance and hoping that poor little accountant is going to figure it out. This payment and banking operation affects every area of the organization. It affects compliance, and this is what we are talking about. It affects finance, obviously. It affects technology, because fintech, technology is massively in it. It affects data security. It affects marketing. Which areas do I target? It affects growth. It affects sales. It affects everything. So trusting your finance person to make decisions on customer experience, how the client is checking out, is a huge mistake.
Yes.
So what I'm saying, we need to agree that this is a standalone function. We need to agree what is the scope of this function. Once we have the function scope, then we can add the bare minimum criteria, the skills, the standards, the best practices, the ethics around this profession. So there are a lot of mistakes coming from not recognizing this payment and banking function as a standalone function and outsourcing it to compliance, to product, to tech, to finance to make a decision on that. It can cost a lot to companies.
Yeah, I agree with you. I completely agree with you. So what do you usually find as the hidden risk in a payment setup? What is the blind spot?
It's cheaper, so it's fine.
Ah,
Every bank is the same, so I just need to pick one. It doesn't matter if it's the green or the red. I'm gonna pick one, and it's gonna be the fine.
it's
It's
cheap.
not the same.
Uh,
Neobanks are more risky than traditional
of
banks.
course.
I would also agree, argue with that. Um,
You say that they are more risky or they are not more risky.
it
What's your
depends on your
approach?
risk tolerance, because as you know, that the banks take government. In some countries, for example, in EU, it's 100,000 in US. But for example, in Israel, there is no government guarantee for bank
For
deposit.
scheme, yeah.
So bank guarantee deposits only exist in certain countries. So first of all, you need to know where you keep your money, right?
Yes, of course.
So that also differs. But for neobanks, what we use as a blanket terms for e-money institutions or payment institutions or your payment app,
It depends though on their license. Some of them are bank; they have banking license, so
yeah,
they are under the government guarantee scheme. Some of
yeah.
them
If
they're not.
But sometimes, if they are not, so they have these bank light licenses or the EMI or payment institution or whatnot, that technically they are obliged to keep the money what you deposit with them in a traditional bank, and that bank cannot use that for fractional banking.
It's safeguarded in a separate account.
Exactly. But that's
Yeah.
what a lot of people don't know. Because if I'm putting a money in the bank can give it out to him as a mortgage, right? So is it safe? Well, obviously there's a government guarantee because of this reason that they are using your money. If you're putting money in an EMI, the EMI is safeguarding it on a bank account, but the bank cannot give it out as a mortgage.
Yeah.
So is it safer? Is it not? That's also just one aspect that you need to
And
consider.
also, the AMI cannot use the money for any other purpose, even their own purpose. It's clients'
Exactly.
funds, it's separate, they cannot use them. So it's a very different setup. And actually, that's the difference between a bank and an EMI. One of the main differences that the way that their clients' funds, the way the clients' funds are used. So,
Yeah, exactly.
yeah.
So going back to your question, so it's like
Yeah. Blind
what of the
spot.
mistakes that you think that it's the same? No, you really need to figure out that who is holding your funds, what country, what regulation, what license, and whatnot. Also, you trust the one department to figure it out. So you say, for example, to product, hey, we need a payment provider. And the product, without having any financial or compliance experience, they just incorporate something which is great for user experience without discussing this with other departments. That is a major mistake, because I have seen so many times finance says, oh, great, guys, we found another payment provider, 0.5% cheaper. Yes, but it
What?
takes, I don't know, half a year for a tech team to integrate because they don't have a proper API to integrate it. So whatever is good for one company, it could be a nightmare for another. So there is no one size fits all. I think that's the biggest misconception.
Yeah, and that's why we need payment experts
Yes,
to help us with
exactly.
that. Yeah,
Exactly.
sometimes it's cheaper. The what looks expensive at the end of the day may be cheaper. So yeah, so what would every CEO understand before choosing a payment service provider?
If you're a CEO and you're choosing a payment service provider, don't. That's my advice, right? In the same way as when you're trying to treat yourself at home, thinking that you've got a flu. Yeah, maybe you do. Maybe it's going to work, but maybe it doesn't. So instead of playing with your funds, go to an expert, because it doesn't cost a lot to have an expert and an expert's opinion, an independent payment expert's opinion, other than pay it later when things go south. And should have, could have, would have known that. Payment experts are, however, different, because there are a lot of people on the market who claim them they are payment experts, but they are actually resellers. So if you're going to a wrong payment expert, in the same way that if you're going to certain kind of doctors, they are motivated to give you certain kind of medicine, certain kind of payment providers. This is not really independent. So you always need to see that how that payment expert is earning their money. And if they are introducers, of course, listen to that, but take it with a pinch of salt. You need an independent person who is fighting for you, who is negotiating the lowest fees for you, who is building the strategy for your business, who understands where the money comes from, how much, how often, what currency, what fits in your company, what is the best for your expansion, what are the payment methods that your target market needs. And it is a very, very complex setup, and it's so easy to make bad decisions. phase delayed funds, frozen funds, closed accounts, nightmares. You cannot reconcile the data, bad customer service, refund, chargebacks, customer uproar, bad reviews. Pay an independent payment and banking expert. It doesn't cost a lot. And do everything right from the beginning, because it is going to cost you a lot in the long term if you don't do it.
Now that you talk about that, I would like to highlight something that a lot of payment institutions, CMIs, and overall companies, any company is scared of: de-risking,
Yeah.
bank de-risking. It's so easy to happen, and companies are so scared. Because if a bank close the account that you have with them, you cannot operate, and probably if you go to another bank, they will also refuse their services. So, what's your professional view on that?
You know how many clients we have that? Oh, I had a bank for 10 years and they all of a sudden closed the account on us. How dare they? I'm like, they are private companies. They can pick their client. They can do whatever they want.
You cannot tell someone with who to do business with, right?
It is your responsibility as a business owner to protect your business and get ready for the worst case scenario. One bank account is not a bank account. One payment provider is not a payment provider. You always need to have a fallback on something else. But it is also your responsibility to understand why certain banks don't want to work with you. Is it because of your industry? Is it because of you're a startup? I don't know you. I don't trust you. Come back in half a year when you've got something to show. Is it because the target area that you're working with? Oh, we opened up in the new markets in, I don't know, Asia, Africa, Latam. Maybe they don't want to work with those monies coming in from certain countries.
Is it because you're vulnerable to financial crime, fraud, or
exactly? Is it because your system cannot filter out even the even the basic level of like fraud or scams? So again, it gets back to having an expert next to you who is at least asking those questions, at least the person is at the boardroom to say that, hey, what about our technology? Hey, what about our compliance? But by the way, are we even legal in that market that we are targeting? Or even just the bare minimum expectations sometimes are not met. And yes, when the panic hits and after 10 years, your bank account gets closed, that's when you're making rushed decisions and massive mistakes, like the firefighters, right? Oh, I need a bank account yesterday. Just open it. It's fine. The bank knows that. You're going to pay for it. You will face worse technology. You will face worse their terms and conditions. So don't make rush decisions. Plan for the future, because it can cost a lot not to have everything ready. And sooner or later, the bank is going to close your account, and you will be in trouble if you're not prepared for that.
Exactly. Now, one of your favorite topics, ethics.
Yes.
It's also one of my favorite topics, so don't worry about it. What does an ethical payment industry look like in practice?
Let me rant a little bit, because I know this payment industry inside out, and I think that we are going towards a very broken setup, and I don't like it, because we are regulating the providers to the core. We regulate how financial companies are working, how they are submitting things, how they are evaluating their risk. No one is regulating the users or the introducers for those financial service providers from the user's perspective. And this is wrong, because anyone can be a self-proclaimed payment expert without any certification, any recognition, any kind of training. Experience. That's the best. If someone has experience, you're already winning, right? But how many people we see that, yes, I was working in a coffee shop, now I'm a payment expert, right? And they are giving advice on your money. There is a reason why financial, like investment advisors need to have a license, because if they give you bad advice, you're losing money. Why don't we force all of those introducers, payment experts, resellers, payment consultants who are introducing solutions for commission, why don't we force them to have a bare minimum transparency, ethics, and education to be able to give you the relevant advice what your company needs? And my biggest problem here is with the transparency. No one is going to tell you that, hey, I know a bank account that you can open, but I'm going to earn for the lifetime of your relationship 0.5% of that. You know how expensive is this? You know how risky is that you're listening to that person, and of course that person is going to tell you where to go because they get commission after you. You are the product in this case. You are the one who is being sold to the highest bidder, where the introducer is getting the most amount of commission, and no one is talking about it. So my perspective here is that the industry need to have a bare minimum ethical standards, which at least just forces these introducers to be transparent. Why are you recommending certain solutions? What is your benefit out of recommending these solutions? And how much of an experience you have, or education or qualification, to be able to recommend any kind of solution, any kind of decisions over companies' funds. We need to talk more about this, because I don't think that in a couple of years we're going to end well if this trend continues. I would give an advice to anyone who got introduced to a payment provider or bank account and something went wrong. You do have the right to actually report that person as well who introduced you. Not that many people know about it, but whoever is doing the introductory work has some kind of responsibility by law to take care of their advice. It's not being executed. So that's why we see a lot of, hey, you need a bank account. These are our prices. We can take even higher risk. How many messages you get like that? But if something goes wrong, do not stay quiet, because that's the only way that you can actually fight against this kind of habit and create an ethical and transparent industry. Or just ask the question that, hey, are you getting commission out of recommending something? Okay, thank you very much. But then, I'm better off paying a payment expert.
I mean, it's biased.
And get an independent advice, and then I screen the full market without any kind of, hidden commission motivation at the background, rather than I'm going to you're going to rip me off, and I have only 5 providers to choose from because the 6th one is not really paying you commission. So maybe use introducers, but understand what are the costs, which is a lot, and what are the risks of using these so-called payment experts or payment provider finders for you.
Good. So another question. Can a payment company grow quickly without increasing financial crime risk?
It is a good question. Yes, it is.
That's my field. So let's discuss about it.
It is a good question, because I feel like every payment provider, financial services company is going through some kind of life cycle. When you're young, you just get the license, you're hungry, your shareholders are pressing you, where is the profit? You are more motivated to take a bit of more risk.
A bit?
Normally, yeah. Even if you're launching as a lower risk company, you're still motivated to take a bit of more risk because it's a higher profit. We don't have that much of a thing to lose. Let's put the money back in the shareholders' pocket as quickly as possible. But as the time grows, you've got more clients. You've got 100 clients, you've got 1,000 clients, you've got 10,000 clients. Then you are thinking twice to onboard an extra high-risk client and risking the whole operation for one new client. And that's what we see when the larger the company, the more established, that's when they start closing those so-called higher-risk accounts, because it just doesn't worth it anymore, right?
Yeah, and actually what happens in real life, when you onboard a lot of high-risk clients, you get the attraction of the regulator. So you get more scrutiny from the regulator. And yes, in the beginning, you're more willing to take more risk. But what happens at the end of the day, you attract more high-risk clients, and at the end of the day, you're trying to lower the risk profile of your entity, so you're more at the standards of the regulator, and you don't get so much scrutiny, because every inspection, every scrutiny, it costs.
Yeah.
And the requirement for companies that onboard high-risk clients that have revenue from high-risk activities are more from the regulator side. So yeah, I agree on that. And we had a lot of cases recently and penalties because companies grew without increasing their financial crime risk department, without increasing their budget for compliance, for anti-money laundering. And at the end of the day, they became target for criminals. So it's very important. I believe that there's no way, that's my opinion, that a company offering payment services to grow without increasing financial crime risk. And yes, the financial crime risk will increase, but you have to increase your budgets. You have to hire more people, employ AI, which can help a lot in mitigating the risk. So this is my take.
And I think there is also a very important aspect that we are not really talking about is the user perspective. Because
Yes.
if you are a business, you have a choice to keep your money with a higher risk-friendly provider or a low risk-friendly provider. Maybe they don't really communicate that with you because by law they don't have to say that I'm a high-risk provider. Your funds are at risk with me. So your money is going to be kept in the same pot than other high-risk clients' funds. And even if you're doing everything right, if any of those other clients are doing something wrong, they have investigation, they have some kind of penalty, then it circles down to the financial institution. And that financial institution can get all their monies, no in, no out, blocked as a whole with your money in it. And this is when some companies realize that, oh, I didn't know that that my money can get blocked because my payment provider is going down. Yes, and this is where your responsibility starts to understand that who is holding your funds, what is the risk that they are posing on your funds, even though you, as a business, you have not done anything wrong. Maybe your money was kept with those companies who did something wrong, and that affects your funds.
Now that you are talking about that, it came to my mind a big case study. Wirecard.
Oh,
Uh,
wow.
I would like to talk a bit about that. I know the story, I've studied deeply, but what went wrong in that case?
Right. Where they went wrong is that they lied that they have a lot of money in a bank which
In
didn't
Asia.
exist. Yeah, well, obviously that was a problem. But from our perspective, I have seen that Wirecard was taking so high risk because they didn't care. Because their portfolio was solid, full with lower risk clients. So they could onboard anything and everything under the sun because they knew that even if that something goes wrong there, the low risk portfolio, the solid base is going to balance out the portfolio and they're going to be still fine. And I have seen that all of those high risk clients went there, they opened account within hours. They didn't really care about what kind of risk they were taking. So even in my opinion, Wirecard wouldn't go down because they lied about the funds. They would have gone down because they were taking so many high risk clients without any kind of oversee and any kind of compliance burden. But that was a long time ago. Obviously now things changed and the
Yeah.
regulator has much closer eye on the
Yeah,
operations.
and I know companies that were willing to pay more because it was more expensive to use the services of Wirecard because the company was reputable. So let's go with
Exactly.
them even if they're more expensive. And yet, what happened, and this is what I would like to highlight, that even people that were not Wirecard's clients, they had problems with their bank accounts, with their cards. Remember that? I was in the payments industry at that time. So it was a huge problem also banks that were using clients of banks that were using Wirecard services were affected.
Yeah.
Imagine now I'm not a client of Wirecard and I try to use my card. I'm a client of another bank and I'm trying to use my card and I can't because Wirecard went bankrupt.
Yeah.
Scary,
Yeah,
right?
but that's happened with Silicon Valley Bank
That's
as
what
well. It
happened.
just
Yeah.
spiraled down, and all the related banks where they kept, because banks are not independent.
Yeah, they work with each
They're
other.
working with each other, right? This bank's money is in that bank's money is in there. So everything is interconnected. And that's another thing that a lot of clients don't understand, that if a region goes under war or they go under sanctions, even though that you don't have money in that jurisdiction, in that bank, you can have problem if the routing of your money is going through that jurisdiction or that country. And that's when you're surprised that why I cannot send money to Kazakhstan, because it's going through a Russian bank. So that goes back to the point that you do need to understand how the system work to be able to make the best decisions for your money flows.
Okay. Next topic, compliance as a competitive advantage. What's your take on that?
Right. I know that that's your favorite topic, right? So I think having a good compliance officer who understands what's going on in the business, who understands the whole industry, is like a gem.
gold.
It's so hard to find. And if you find that person, stick to it, because that person can save you so much money that you have no idea. And it's the same way when you are paying for an insurance and you don't even worry about, okay, if it's a reputable company or not, until they need to pay you out. It's the same thing with a compliance officer. Like, the better the compliance officer, the more solid your insurance is, that you will not get the penalty. Your business is not going to go down. You are not going to have headaches. And a good compliance officer is not just reactive, saying yes, no, yes. It's working with you, helping you to build the strategies, to build the processes, to help you in every step of the organization, to highlight that maybe that happens, the what if, what could go wrong. A good compliance officer is just a blessing for your company. I think this is one of the strongest positions, whatever you have in your business. But again, people don't necessarily see that. And the interesting part is that when we are talking about compliance, everybody's talking about, oh yeah, the regulated entities, the brokers, the financial companies. No. You still need to have a good compliance officer, even if it's not on full time. If you're a jewelry shop, if you're a car salesperson, or for example, real estate agency, every time when you accept a large amount of funds, you are at risk. Every time that you're accepting larger amount of funds, you are at risk. And not that many companies understand that. If your best client walks in with a bag of cash and puts it on the table and say, I want the best what you have and I want 10 of it, your compliance officer is going to jump in and say, no. Let's see. What's the risk versus what's the benefit here?
Yeah. And actually, what I always say is that you never know how much money a good compliance officer have saved you. You know how much sales a salesperson is doing. It's a number, you can see them. But you never know how much the compliance department is saving you, because you're not getting penalties, because you're doing things the right way. So some companies, they believe that compliance is just a black hole where you throw money. It's not like that. They're protecting the company. And a question that I usually get about compliance, what do we do if the board of directors doesn't give us the budgets? And my take on that is that probably, maybe it's our fault. We don't help them understand that indeed we are actually on the same team. We are trying to help the company grow, but help the company grow in a compliant way that will not cause us trouble with the regulator. So if you can't convince the board that you are on your side, then stop everything else, focus on that, because indeed, compliance officer, that's what we are trying to do. We are trying to help the company grow. We are on the same team. That's my take on. So it is a competitive advantage because it protects you, and above all, it protects your reputation. Without a good reputation, no business can survive. And yes, I agree that even non-regulated business need to have some type of compliance. And does it make sense now? The client brought me a bag full of cash. Common sense. Where did the client? Why cash? So think about it. And this is something that companies often are not doing because they are not regulated. But still, under the law, they can get a penalty because either assisting money laundering or it was too obvious and you ought to have known, as they say. So you didn't know because you didn't ask the right questions, and you may get a penalty for that. So yes, it is a competitive advantage, and I think you agree on that, right?
I think it's very similar to your accountant. Your accountant could be a person who says, yes, no, ooh, we got a penalty. Or it could be a very proactive role in your company. Hey, we should do that because then do the budgets, thinking about it. Okay, we are cutting costs. Who is like proactively working within your business to give you the best advice, what you can apply on the operation. That's exactly the same thing with compliance. If your compliance officer is like, yes, no, maybe, then it is not that kind of compliance officer that you want in your side. You want someone who is proactive, who is advising on the procedures, who is highlighting all those risks, who is actively interested in new activities, talking to every single part of the business. What can we do differently? What shall we change? Shall we take that risk or not? Who is working with the board together and not just taking that passive role of yes, no, maybe.
Yes, and actually, good compliance officer, or because compliance officers are often busy, a good compliance consultant help the company understand their risks, which is often a huge gap in company. They take measures, they do A, they do B, but they don't understand the real risk. They have their risk assessment on paper, they're doing everything the right way, the buffers or everything that the regulator requires, but then something happens and they are not prepared. This is an indication that they don't understand their risk. They didn't really understand their risks. And that's the job of a good either compliance officer or a compliance consultant.
Yeah. And one more thing, compliance, just as payments, are very subjective topics because it's all related to risk. And it's up to you and your business to see what kind of risk are you willing to take. Because if you're not taking risk, you can close down the business. Then you're not trading at all. You're not accepting any funds. You're not opening any accounts. Stays.
No risk, no business.
No risk, no business. So you do need to find that very fine, thin balance of how much risk you are taking for what benefit. And that's where a good payment expert can help you. That's when the good compliance officer can help you to highlight that you can do it, but these are the repercussions. These are the risks. These can go wrong. And once you see everything in front of you and not making any decisions on a gut feeling, that's when you can actually make informed decisions over your business.
Okay, so last question. Should companies slow down innovation because of risk?
Again, it's a very double-edged sword because I have seen a lot of companies not even coming to Europe because they think it's overly regulated. And this is the trend that we see. A lot of companies are leaving Europe because you can't really make business here. The regulator is getting involved here, there. They don't want us to do business. We're off to US. We're off to the Middle East. Yes and no. When it comes to longer term planning, when you're building something scalable, something for the long term, you do need to have some kind of regulation. Do I think that there is too much regulation? Yeah, definitely. At one point, maybe it just hinders innovation and you're just overregulated yourself. Many times, yes, the regulator does not necessarily understand the private sector, and then they are getting involved in things which they don't have a clue, and that's basically breaks the business. Yes, there are cases like that too. But having a free market without any kind of regulation could be super dangerous. And that's what we have seen, for example, 2008, there was a deregulation. And then America just drove us into a financial crisis.
Global financial crisis.
And everybody was like suffering. So you do need to see that, yes, regulate, yes, deregulate in case that you realize that there is a problem. But there still has to be a balance here, because if we just allow companies to do whatever, however, whatever, it's not necessarily because they do want to create harm, they do want to do something bad, but accidentally they will.
They will. And it's all about consumer protection at the end of the day, because customers are the ones who are paying at the end of the day. Yeah. And they are not responsible for that. But still, if there's no regulation, the customers are the ones who face the consequences.
And the larger society. It's the same thing with the seatbelt. Yes, you can choose to click on your seatbelt or not and die or not, but I have to pick up the tab as a taxpayer to fix you in case something goes wrong. So you do need to understand the larger effect on society. If a business goes down, they are firing people. Those people are going on unemployment benefit. Their kids are going to have worse conditions. So it's not just my business, my rule, my money, my rules, I go to jail, I don't care. You live in a society, and societies need to govern some kind of behaviors which is good for the larger society. Yes, you might think that, okay, why I cannot innovate because this is my business. If I go down, I get the penalty. But you have spiraling down effect on your jurisdiction, on your country, or even a whole area if it's not regulated properly. And that is the responsibility of the financial regulator.
And we have seen a recent example, FTX.
Yeah.
Who paid at the end of the day?
Exactly.
The customers, right?
Exactly. And as we said, that all the banks are interconnected. One bank makes a mistake, that is going to affect another bank with the customers, another bank with their business clients, another bank with pensioners. So you can't just separate that, yes, this is a problem for this industry and this needs to be regulated. Everything is so interconnected. So you need to defend the whole system as a whole. And going back to trust, this is what banks need to need to see.
Because if people lose their trust, your business is down. Everything is finished.
Exactly.
So it was a big pleasure to have you with us. Thanks for being a guest at Risk Explained, and we'll be in touch. Stay tuned for more episodes.
Thank you so much.